Do you have some sort of thought process or framework that you go through, or is it just years of experience and feel that you know that okay, this is now at a right price?
I think most people would have understanding if they actually push themselves to do it. It's not that I have any special insights or understanding. The first thing you need to do, Varun, is you need to understand what the market cap of a business is. Number of shares outstanding times the current price. You go to any decent software, get the market cap by rote almost, right? So you understand what a business is valued at. You add the debt to the company, you come up with enterprise value. And then you ask yourself a very simple question. Would I pay that much to buy 100% of the company? Or would I, not pay that much if I were a private businessman? Now, most people are very afraid to ask themselves the question. So I'll give you two shortcuts. The first thing is try, say you're a novice investor, instead of looking at companies like Reliance or Tata Steel, which are in the few lakh crores, you start up companies at 1,000 crores, 2,000 crores, 5,000 crores, because you understand that business. And how do you understand the business in a sharper format? Look for your circle of competency. For example, you're a software person from your background. So you look at software companies. We look at software startups, the smaller end of software companies, not the Infosys TCS. It is called the circle of competency. So if you're a banker, you can look at the financial stocks. If you're a practicing doctor, you look at the medical, the pharmaceutical companies. And that will give you an edge that the last you gets, few years later. Because you're already in the business, you understand how the business is doing. So rather than being a mogul in software and steel and salt and consumer business, try and find your area where you have an edge and use that edge to your advantage. So to come back to the point, this is how Warren Buffett explained. I think it's a great explanation for it. Is that, and I'll change the baseball analogy to the cricket analogy so that people understand out there. We tend to think of the stock market sometimes a T20 game, that every ball you either score a run or get out, because it is very important. You only get 120 balls to play in an inning. So every ball is of particular importance to you. The stock market is not like that. It's like a 5-day test match where you can bat for as long as you want, 2 days, 3 days. And every time a pitcher throws a ball to you, imagine he's throwing a stock to you. Infosys at 1,400, Reliance at 2,500, ITC at 400 rupees. And you have to do nothing. If you don't like the price that is being thrown at you, ignore the stock. But if it comes at a price that's very attractive to you because you've already done the homework in terms of market cap, in terms of enterprise value, in terms of the prospects of the company, you say, how is that possible? And typically in bear markets, you'll find, as to use the cricket analogy, the white ball outside the off stump, you can hit over the top for a 6, okay? Right. Because there'll be that kind of value delivered at that time. So market is very schizophrenic. But the beauty is you don't have to do anything. You can wait 3 months, 6 months, 8 months for the fat pitch outside the off stump, which is a full toss, you swing out of the bat. So it does require an enormous amount of patience, and it does require, as Warren Buffett says, temperament. You need the right temperament of what you do. But occasionally the market will give you this absolutely soft ball outside the off stump, which you can hit out for a 6. And that's what you want to do. It's not that by batting every day and hitting every ball, you're going to make a lot of money. It's by backing up the truck and buying when odds in your favor. That's when you make the serious money.
I think that's a really lovely analogy, because I think in your career as an investor, you've hit a fair few sixes, as you've identified the right points, the right trends. I think Infosys, when it was in the 90s, recently I think PSU and railway and defense stocks, I think you were fairly early with. So how do you find this? How do you find these? How are you certain that what you've got is a softie that you can really hit out the park?
It's funny you ask me these questions, because I told my wife a few days back that, my stocks have been done well. And she replied, as only a wife would, that Kismat Balwan to Bheda Pelwan. So she knows how to put me in my place. But levity aside, trying to understand what you're doing. One of my first breaks in life was a company called CMC, which did the entire railway computerization project for the government of India. And when it got listed, it was a 20 crore market cap. And I knew from my background as a computer programmer that it was silly money. It couldn't be that way. I didn't understand markets, but I understood that you couldn't get a computer company that did the Indian railway system. They did the Bombay Stock Exchange system, 20 crores. You would probably spend 100 crores at IBM just to get a RFQ from them.
Yeah.
So I knew it was simple. I didn't understand markets, so I made a mistake, which I'll get to later. So it was within my circle of competency, and it was the soft pitch outside the off stump you could hit for a 6. Because at 20 crores, I knew I couldn't lose money. How much I made, even I didn't know about it, but it ended up being almost 100 bagger. But leave that part aside. To give you a more contemporary example, because of that circle of competency I developed in the public sector stocks, I kept following them. And when this new round of PSUs came public, the defense and the railways you mentioned, I'd done my homework on them. For example, to give you an example, a company called Mazgon Docks, which I own, so I'm not recommending it. It's just a disclosure that I do own a part of it yet still. The company was coming out as an enterprise value of a few thousand crores, 2,500 crores or something. But enterprise value was actually closer to zero because they had so much cash and land in the balance sheet that basically was getting the business for free. And what were they getting in return for the business? I was getting an order book of 50,000 crores, which would last them 5 or 6 years. So I knew for the next 5, 6 years, they would make money and pay me a dividend, right? So it was that great a bargain. So when I tell you the example that operate within your circle of competency, that was within my circle because I'd watched these stocks for very time. Wait for the fat pitch outside the off stump. Here I was getting a company with basically an enterprise value of zero. Enterprise value. The only thing I have to sit that if I throw a party, will people show up or not? Luckily for me, it worked out. Corporate governance improved. People understood the earnings, and the stock multiplied many-fold. So that is the part where luck and patience comes into play. But that's a classic example of how a value investor would tend to approach something. It's like your mother taught you how to shop. कि रुपये की चीज अठन्नी में खरीदो, रुपये की चीज चवन्नी में खरीदो. That's what you do in the stock market also. You want to buy something that you think is worth 1 rupee or 10 rupees or 100 rupees for a fraction of its price. And then there should be a trigger unlocking that value.
Right.
And that will typically happen if you buy a good company.
This podcast is produced by Elixir Equities Pvt. A SEBI registered research analyst. Registration number INA 0000004787. The information provided in this podcast is for educational and informational purposes only and should not be considered as investment advice. Investment in securities market are subject to market risk. We strongly advise all investors to read all related documents carefully before investing.